Every stock market has a way of measuring fear. When uncertainty rises, this gauge tends to spike. When investors are confident, it usually falls. In India, that role has long been played by India VIX. But now, the National Stock Exchange, or NSE, is working on something new, a new volatility index with a different methodology and potentially a new way of measuring market risk. So what could it look like, and why is NSE looking beyond India VIX? According to Business Standard, the NSE has begun preliminary discussions on developing a new volatility index. It is considering multiple methodologies and a pilot is expected soon. The new index would be different from India VIX, which is currently India's benchmark measure of expected near-term market volatility. The testing phase could take several months. During this period, the NSE is expected to test how the index performs under different market conditions and whether it accurately reflects changes in investor sentiment. The exchange also plans to consult market participants, academics, and other industry experts before taking the proposal further. To understand why this matters, we first need to understand India VIX. India VIX measures the market's expectation of volatility over the next 30 days. It is calculated using Nifty 50 options prices. Importantly, it does not predict whether the market will rise or fall. Instead, it measures how much investors expect the market to fluctuate. A higher VIX generally signals greater uncertainty or fear in the market, while a lower reading suggests investors expect relatively stable conditions. That is why India VIX is often called the market's fear gauge. So why is NSE exploring a new index? One possible reason is derivatives. A new volatility index could eventually support volatility-based derivative products. NSE had earlier launched India VIX futures in 2014, but those contracts were discontinued in 2017 because trading volumes and investor participation remained low. Any derivatives linked to a new volatility index would also require fresh approval from SEBI. Another reason is ownership. The term VIX is a trademark licensed to the NSE by the Chicago Board Options Exchange and S&P Dow Jones Indices. Industry experts say developing an in-house volatility index could give the exchange greater flexibility over its own benchmark. A different methodology could also make the index better suited to today's market structure and trading patterns. For now, this is still at an early stage. The NSE has not officially confirmed the details. So whether the new index eventually replaces India VIX or exists alongside it remains to be seen. But the exchange is clearly rethinking how market volatility is measured in India, a move that could eventually shape the next generation of trading products. For most investors, this won't change how they invest day to day, but it could change how markets measure risk in the years ahead. Because markets don't move only on earnings and interest rates, they also move on expectations and uncertainty. And that's exactly what a volatility index is designed to measure. Follow Business Standard for more stories.